Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions from your own financial conclusions and make your own financial decisions. This is Blockhead Traders for the week of December 29th, 2024. And in this week's episode, it's just myself, Sprocket888, and this is the last recording and the last release of 2024. And I thought I would take a moment to touch on option assignment. So as you know, I'm always selling premium. That's just the thing that I like to do. And with selling premium, there comes a risk of options assignment. And options assignment is what we're going to talk about today and why there's really nothing to fear about options assignment. It sounds scary. People will tell you it's scary. You might read things about how it's scary. But being someone who has gone through a lot of this options assignment, it's really not scary. And we're going to talk about why it's not scary and what happens when you get assigned and what might cause you to get assigned. Before I hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. You can also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find us there, let us know and we will get it there. But let's hop to this week's content. Like I mentioned, this week's content is going to talk about options assignment. An options assignment is something that just comes with the territory of when you sell options naked. What that basically means is you don't have a protection leg. And so this is something that's core to the strategy that I go through. And I'll be honest, it was a very, very scary thing for me the very first time that I went into an assignment. And actually, prior to getting assigned, it was quite nerve-wracking about will I get assigned? What will happen? What's going on? And there just was a lot of uncertainty around it. And so I want to take this episode to talk a little bit about what leads up to assignment, what you can expect, because I really think a lot of that fear and that apprehension stems from just a lack of understanding on my part, no experience being through it. And I had read a lot of different things on the internet about people that had gotten assigned. And once I had been through it, understood it, I just want to kind of impart some of that knowledge to you guys to maybe help you guys feel better about assignment or be less apprehensive and worrisome when it comes if you dabble in this style of trading. So before we hop into some of the details here of, what to expect, I want to kind of rewind a little bit just to cover some of the basics about an options contract. Now, there's other episodes where I cover more in-depth basics and things like that, so go ahead and take a look through our back catalog. However, for the purposes of this discussion, I'm going to recap just a little bit about these basics. And what we're going to start with is what exactly is the options contract that we are selling. So in this arrangement of when you are dealing with assignment, you are typically the option writer, okay? This is the person that is generating the option. This is the person that is selling the premium. And what that is it's effectively a coupon with an expiration date that you're going to sell for some type of premium. Now, there are two types of coupons. The one that I'll focus more about here is the put coupon. And this is where I really would recommend most people start when they want to start selling options naked. There is other dangers that can come with the call side. So everything that I talk about here can kind of be reversed for the call side, but we're going to focus on the put. And the easiest way to tell the difference between a put and a call, and this is probably one of the number one things that new traders get confused about, is when you deal with options, you're either buying or selling them, and then you're either doing the put or the call, and they'll tend to get them reversed, tend to get confused with which direction the trade is going. And so the way that I remember them is always think of it from the perspective of the person that purchases the option. So the buyer of the option, because the buyer of the option is the one that holds all the power. And what I mean by that is the person that holds the option, that owns the coupon, they can choose whether or not to exercise it. And this is where I make a distinction between put and call. Put means they have the ability to put those shares to you, the seller, and that's if it's a put contract. So remember, put, they can put shares to the seller of the option. And call means they can call away from the seller of the option the shares. So put another way, or described another way, if you sold a put, you are obligated to buy the option if it goes over your strike price, if it's in the money, and the option holder, the person that paid you the money, wants to exercise. And so another way to kind of think of selling a put option is very, very similar to writing a limit order. Okay, so a limit order, if you're trading normal equities, says you typically enter your limit order below the price that it's trading at. So let's say something's trading at $100, and you say, you know what, I will buy it for $90. If it hits $90, I'm going to go ahead and buy it. So you would put in a limit order and say, if this price hits $90, buy me 100 shares. So in that case, you will get those shares, 100 of them, at $90 if the price goes below $90. Now, this is where selling a put can come into play. Okay, so selling a put means you could sell a coupon that says, I will buy 100 shares. So each coupon represents 100 shares. I will buy 100 shares of stock, whatever it is, for $90 if it gets below that. So you would sell a coupon to the option buyer at $90, and you would collect some sort of premium for that. Maybe you collect, $2 for the contract, which 100 shares is $200. So you would get paid $200 to wait for that strike to go below $90. And if it did, that option buyer could put those shares to you, and you would be forced to buy them at $90. Okay, so hopefully you're starting to maybe connect some of the benefits here. It's very similar to a limit order, except you're actually getting paid for it. Now, where people get into trouble, and this is where it's very important to understand what are you trading, is understand what the contracts that you're writing represent, and be okay if you have to take assignment. So for example, if something was, $90 and I'm willing to buy it at $90, and maybe I'm only willing to buy 100 shares at $90 because that's how much money I have to pay for that $90 a share, I shouldn't sell 5 option contracts, because if I did, I would have to buy 500 shares. And if I don't have the money or the capital to back that up, then in that case, I would be very, very worried of assignment. And I think this is the very, very first thing that you have to be cognizant of and be aware of, is understand what you are obligated to buy and make sure that you are willing to buy it. So if you're not willing to buy it, you should not be selling the options against it, because you're effectively writing checks that you cannot cash. Now, one other difference that I want to call out here between a limit order and selling an option contract, and this one took me a while to really kind of fully understand and fully witness, is in a limit order, the minute that price drops below $90, you're going to execute that order. Okay, that's not how options contract works. Could the person who has the option early assign or basically call assignment at that point? Absolutely, they could. Do they? Pretty much never. And that's a big, big, big difference. Is you will dip below your strike. So maybe the option, or maybe the price goes down to $85. You probably will not get assigned unless you are the day of expiration or close to it. And even then, you still might not. And so it's not like a limit order in the fact that it will execute right away. It basically, the option holder has to manually exercise it if they want to do it early. The only time that it is automatic is at the end of the option's expiration, after the market closes. If the market closes in the money, they will automatically be exercised. That is the only time that an option is automatically exercised. Under all other conditions, it is a manual exercise of the option holder. So again, this is a very, very important understanding that it is not like a limit order. And the minute it goes below your strike price, you are not going to be assigned. The person that has the option has to manually exercise it. The other super important thing that I want to call out, and this really I didn't fully understand for quite some time, is I was under the impression that these options, when I first started selling them, was I would be assigned the minute that somebody manually exercised. So in my head, I was thinking, oh, we would be trading along the day. The bottom falls out of the stock and it drops, well below the strike, and somebody turns in their manual exercise. I thought, oh, great. If I get assigned because they turned in my coupon on that assignment, I'm going to have to buy these shares in the middle of the trading day. This is absolutely not true. This does not happen. All assignments and options assignments happen after the market closes. So you basically, if you are not assigned when the market opens, and you'll know because your brokerage account will say you've been assigned the option. If you're not assigned when the market opens, you will have that whole trading day to do whatever you want with that option, and you cannot get assigned during the trading day. So the way assignment really works is everybody who wants to be manually assigned the options, or basically wants to manually exercise their options, they put in their requests with their broker and say, hey, I want to exercise my option right to exercise this option. And then what happens is after the market closes, all of those requests go into the trading board of options, and they are randomly assigned to the people who have sold those options, which means that it's not a 1-for-1 match on whoever bought the contract from you. It just goes, you're in a pool that says this person will buy at $90. And so anybody that turns in a coupon to for that $90 put, it will be randomly assigned to everybody that had sold those contracts against it. So that's very, very, very important to know, especially as you push these things into expiration. If you choose to do that, is you really have the entire trading day. There is no panic closure that you have to do. As long as you get out of the option by the end of the trading day, you cannot be assigned. So real quick, just a couple of key things there that I just kind of mentioned is, one, selling an option, particularly a put, is very similar to entering a limit order, because you are saying, I will buy this stock at this price if it is below that price. The only difference is you get paid to sell that coupon. Secondary thing is your assignment is not automatic. So it's not like a limit order that just executes as soon as it drops below. The holder of the option has to manually exercise it. The only time an option is automatically exercised is on the day of expiration after the market closes. And the last thing to remember is that your manual assignment does not take effect until after the market closes. That means if somebody manually exercises their option during the trading day, it does not settle and it does not execute until after the market close. So if you had a contract and you sold it and you close that out before the end of the trading day, you will not be assigned. So only those people who sold options and did not close them out after the market close will be in the pool of random assignment from the options board to pair up to all the people that had turned in their manual exercise. Now, what I'd like to do is take a little look at an example of an option trade that I have recently done on where I was assigned, and kind of talk you through what did that look like and how did that fare for me. And so I'll show you a couple of different ways. I'm going to show you the graphical table chart of the price. But before I do that, I want to show you the table of the premiums that I had collected and the dates in which I had collected that premium. So this is all on SBUX, and I had originally started this trade as an earnings strangle. So an earnings strangle is I was selling a put and I was selling a call, which means I was okay to buy the shares at the put strike or sell the shares at the call strike. There was no protection leg, so this was basically trading naked options. And so on April 29th, I started this. I sold two strangles, and I collected $296 for those two strangles. Now, Starbucks had their earnings, and that went way down. So my put was at $83 because I had looked at the price of Starbucks, I had looked at the charts, and I said, you know what? I'm okay buying Starbucks at $83 a share. And I was okay to buy 200 shares of Starbucks. So these are all things that went through my head before I sold that first strangle. So when you sell the naked options, you absolutely positively must be okay with assignment. So in this case, I was. And so I had collected $296 and it breached my strike and I was in the money. Now, I did not get assigned initially. Okay. So this is where, even though Starbucks dropped down to like $72, it was $10 below where I said I would buy it at. I was not assigned automatically because the option holder did not manually exercise. And so what I did was I rolled that strike out. Now I had left the call alone because the call was way out of the money. We were never going to touch it again. I'm just going to collect all my premium on that. But for the put side, I did what's called a roll. And so I extended the play. So it was going to be expired. I don't remember what day it was, but it was that week of earnings. And so what I did was I rolled it out to the monthly. And when you roll it out in time, you basically collect more time premium. It also decreases the probability of assignment. So the closer you get to options expiration, the less extrinsic value the option has. And as long as there's not much extrinsic value, then there really is a risk of early assignment. But if there's extrinsic value, the risk of that assignment is much, much lower because whoever exercises it is throwing that value away because that extrinsic value just goes poof when you assign it. So I was able to roll that out to that monthly expiration, and I collected another $390. Now, unfortunately, in this case, we started approaching that expiration date, and I was not assigned early. So even though this stock was almost $10 in the money, I was not assigned early. Basically, I went on the day of expiration and I didn't close the option. I didn't roll it because there really was almost no premium to roll it out another month. And so I said, you know what? I'm just going to take assignment on this because selling the call side and having the shares was a little bit more lucrative to me. I thought it maybe made more sense. And so on May 17th, which is when those options expired, they were exercised and 200 shares were put to me. Because remember, I sold the put. So the option holder pushed those shares to me at $83. So I was obligated to buy them at $83. Now, you're like, oh, great. So what's the big deal? I mean, the big deal was the Starbucks was trading at like $72 that day. So yeah, I could have bought them on the open market for $72, but I had to pay $83 because that's what my contract said. That's the contract that I sold. And I have to be okay with that because you really can't change that once you sell that. You can close it out, but if you change it, you're going to take a loss if you're in the money. So I now had 200 shares of Starbucks, and I started to look at the option chain and said, well, I'm going to sell calls against it. And what that is now I'm selling coupons where people can call those shares away from me. Okay, now you might think, well, why would you do that? Well, I have the shares now. So these are covered calls. There's really no risk to it. I mean, the only risk is that the price goes way, way, way above my strike and I leave money on the table. So when I chose my strikes to sell the calls, I made sure that the calls that I was selling was at or above my price point or my assignment. So I was selling $83 calls or higher. So I kind of kept ratcheting up the calls that I was selling as time went on and price kind of appreciated. But the first ones I did, and I did two of them, was on June 6th, I sold two covered calls, collecting another $254. So time passed and Starbucks did not make it above that call. It stayed below. So those expired worthless. And then I went and I sold two more calls. Now, in this case, I ratcheted up the strike price a little bit higher and I sold two more and collected $120. Actually, sorry, I probably didn't because that was a less of a collection there. But I did sell two more. Then July came along and I sold two more because the ones previously also didn't breach and they expired worthless. So that's one of the benefits when you sell these coupons out of the money. If the price never gets above that, you keep your premium and you don't have to buy or sell the shares because it never really reached it. So you're basically getting paid to wait for the price to hit where you want it to hit. And if it doesn't, you just sell a new set of coupons. And because these coupons expire, it's not like, a limit order where you do a good till canceled. Your limit order is time bound by whatever strike monthly expiration that you choose to sell. So again, time went by. I sold two more at $252. Now, at this point, those expired worthless, and StarBucks had a giant rocket and a gap up, actually going above the strike price on which I was assigned at. And so that last on August 13th, I said, you know what, I want to take up the opportunity to get rid of this. And I basically sold a call at the money. So my other previous calls were well outside of the money because Starbucks was trading so low. And I wanted to make sure that I was selling a strike above my cost basis, above that $83. So there I collected another $1,000 and just waiting for somebody to early assign me. And while I was waiting, basically Starbucks had a dividend date, and I had 200 shares, so I collected $120 from the dividend, kind of still waiting. And then finally, on September 20th, I was assigned because the last two calls that I sold were at a $90 strike. Remember, that's $7 above where I was assigned at. So when the person that bought them, now Starbucks was above $90, but they called those shares away from me for $90. So I had to sell those shares at $90, even though the market was trading those shares much higher than $90. So that's the other thing is you have to be okay at the price that you're doing the exercise at, even though the market could be substantially different than that price point. It's just something that comes with the territory. And so I collected $18,000 from selling that. I had to buy those shares at $16,600 earlier, but $90 is what that person bought them from me for. I had 200 of them, and so I collected $18,000 from that. So add all of this up, and you'll see that this whole trading range, I netted $3,832 collected from that. And you might think, okay, that's not that much. But remember, everything other than the two assignments is premium that basically came from nothing. And the cost basis or the buying power that I needed was about $8,000. And because I have margin accounts, effectively, even though I had to purchase the shares at $16,600, the buying power is about 50% of that. Do I have to put up in cash? The other half of that, the brokerage puts up as part of margin. So if you want to learn more about margin, go in, read about your broker, Google some videos on it. It's a way that lets you share the cost of purchasing things for a price. So you can see that this whole trade, if you take that $3,800 that I collected and you divide it by about $8,000 of buying power, that's almost a 48% return on capital, which is really, really good, particularly over the 4 months that I had this trade open. Now, the last thing I want to show you here before we wrap it up is I want to show you graphically the chart of what this kind of looks like. And so this is the chart of the price movement of Starbucks while I was holding it. So over here is the strangle. This is the price action where, we were right in the middle here around mid 80s. It just fell through the roof. This is where I ended up getting assigned. These big block tiers here are where the call was that I sold. So this first one was sold at 83. I then sold the next one a little bit higher at 85. And the reason I collected less premium was because the price was further away from that. And then here it was pretty deep. But because I had collected premium, I actually sold this one at 80. even though that is less than my assignment price, when you factor in all the premium that I had collected, it was above my cost basis. So this wicked up actually on this day. And this is where this is important to understand, that even though price goes above that, you do not get assigned unless somebody manually exercises their right. And so this is a perfect example of where Starbucks really gapped up, wicked up, was above my strike, where I could have been called away if those people had chosen to early assign me. But like I said, early assignment is incredibly rare, especially if there is extrinsic value in the option. So they did not manually assign. The price fell back below that and it ended up expiring worthless. I kept my shares, I kept the premium, and that is really one of the things that is very, very important to remember. So if you have a covered call and if you're okay with assignment, I say play chicken with that train. Just ride that train into expiration. You don't need to roll super early if you don't have to. You might want to push it, because if price starts coming back, maybe you get a better roll price. Or maybe if you're fine with assignment, you just want to kind of keep going because maybe it's going to drop below the strike and you won't get assigned. And that's really where the comfort of assignment really, really shines, is because it gives you the flexibility and the mental capacity to basically keep charging towards that expiration date, because you understand what's going to happen if you get there, and you understand what's going to happen if there is a manual exercise, and what might happen below that. Because what then occurred after that is this thing price shot up well above 90. And this is where I opened up that $90 put, or sorry, $90 call, is now we're above. And I basically did that right at the money. And you can see Starbucks got up to, 98, came back down, came back up. And so the day of expiration here of when I ended up getting assigned on the 20th of September was about $96. So $6 above the strike that I had sold it at, but I didn't care because it was already green. And it just goes in my brain with the mentality that I have, is that I will never, ever, ever sell the absolute top, and I will never, ever, ever buy the absolute bottom of something. And so I'm just okay with the target price returns and things like that. So this whole trade ended up being about a 48% return on capital, which is fantabulous. Most of my trades, I try to target around an 18 to 25% return on capital. This one, because I was holding them, collecting dividends, and then just selling covered call after covered call after covered call, I was really able to kind of keep racking up the return on capital, because the amount of capital it took me to hold those shares, wasn't really changing over time. And I'm just collecting more and more premium against that capital that I had to put up. And so this is really where the power of assignment and the power of covered calls can really come in. And it's just how this plays out. And the more that you understand it and the more that you are comfortable with it, the more flexibility and mental capacity and the trading psychology will you have to go into these situations. So that brings us to the end of this week's episode. Hopefully you guys learned a little bit about assignment, a little something that you didn't know before that might make you a little bit more comfortable. I really, really, truly believe that if you have the capital and the good understanding of assignment, that it's definitely the best way to trade options is naked. And that really means that you have to pay attention to those strikes, and maybe your capital is not to the level where you can take 200 shares at $100 a share or $80 a share or $90 a share. Okay. That just means you're not trading that underlying. Go down into a stock price that is more what you can exercise your 100 shares, 200 shares. Maybe you're going to look at underlyings that are trading in the $20 to $50 range. You really can find anything that fits all different trading sizes, trading portfolios, risk tolerances. But you really get the most benefit, in my opinion, of selling options naked. Whether that's the put or the call side, you get full exposure to the options Greeks. Go back to some of my other videos to learn more about the Greeks. If you can't do it because you're afraid of the assignment, or you don't have the capital and you need to control your risk, that's where your verticals come in. That's where selling or buying the protection leg comes in. which is a perfectly fine way to trade. And I do many of those trades. In fact, probably the first year and a half of my options career was 90% options verticals. But then once I kind of got my portfolio up a little bit bigger and I really started understanding the mechanics and I really understood assignment and what it meant, and I was less scared of it, less apprehensive about it, and I did my position sizing based on my portfolio size, based on my risk tolerance. All of these are factors which really make assignment not a scary thing. And all of that has to go down to understanding what you're trading, understanding the mechanics of what you're doing, because the more that you understand, the less fearful things will be, because it's not an unknown anymore. And that's what really drives most people's fear, is a fear of the unknown. And so educate yourself, go through paper trading, hop in the Discord, ask myself some questions. I have definitely been through many, many options assignments, and I have on both the receiving end and then assigned to get rid of the shares. And so it's a full cycle, a sign coming in, a sign going out, collecting premium all along the way. I hope that each of you have had a wonderful 2024 trading year. The new year is just around the corner, and we will be coming back with some new episodes, some new content, looking at the strategies and stuff that Viper and myself will be deploying. There's a high probability of some volatility coming to the market. It really started kind of creeping up here the past couple of trading days here as we close out 24, and volatility is something that premium selling is just oh so right for. And so I'm super excited about that upcoming. Hopefully you're finding the strategies that you like to trade apparent and recognizing them in the market, and you're hopefully hitting them with good fortune. Remember, as always, keep on trading, and remember to think outside the block.